The three biggest mistakes stock market investors make. I believe all of us in the market go through the same phase. We go through the same story. We learn the same lessons. And that's why I love sharing my experience and sharing the mistakes I made and things I've done in the past. So you guys don't have to repeat the same mistakes I've made. And if I could help one person with this video avoid some of those mistakes, then I would be very, very satisfied. And that's why I try to do those videos. I did a video on how to value any stock. It only got 6,000 views, but a lot of people tell me it's a gem and they don't get a lot of attention. So if you enjoy such video, educational content, all I'm asking is please press the like button and let me know what you think in the comments. The first mistake, and this is the biggest one that I see in the market today, is paying up for quality. So anytime I talk about a stock that looks expensive like Netflix at 110 or any stock, and the multiples, the PE ratio or any multiple clearly looks expensive, if you value the stock clearly looks expensive, people tend to have the tendency to believe that because the company is a quality company, then it must deserve a premium, right? I mean, it makes sense. It's not going to trade at 5 times earnings. It deserves a premium. Now, the question is, how much of a premium does this company deserve? I'm going to use Netflix as an example because I recently talked about Netflix at $110 and everyone was saying that this is a generational buying opportunity. And I said Netflix was too overvalued with my fair value of $87 per share. Now, if you just look at it, just a common sense analysis, this is Netflix at $110. At $110, Netflix was trading around 35 times forward earnings. 35 times, guys. How can 35 times be some kind of an amazing buying opportunity? How can 35 times be, like something that you're paying up for quality and you have a margin of safety to the downside? This is the biggest misconception people have is, yes, you need to pay up for quality sometimes, but how much of a margin of safety do you have if the company doesn't perform, if Netflix doesn't grow as much as is expected? If you're paying 35 times, then you have massive runways on the multiple. It could go to 27, 25, 23, 22. But if you're paying 25 times earnings, 23, 22 times earnings, then at least you have some kind of a floor near this level versus if you're paying 35, 40 times earnings. But the main reason why people pay up for quality is because they believe the stock will never become fairly valued. It will never get to 87. It will never get to 82. It will never get to $80. So they FOMO and they overpay for quality. It's the same with Salesforce, CRM. CRM's earnings per share has grown 240% over the last 5 years. The PE was at 170 times earnings. It went to 17 times. The stock price has done nothing for 5 years. So if you were right on CRM, on the growth of CRM and everything, you still lost money because you paid up for quality. It was trading at 50, 60, 70 times earnings. Before AI, even before AI, the stock was going down, and if you overpaid, you lost money. It's the same with Adobe. Adobe is going down right now. And I said Adobe is an opportunity. But before, in my previous video, I said Adobe was overvalued when it was trading at 35 times earnings, and you should trade at 50 times. So when you're paying those multiples for a company that's growing 10 and 11% in earnings per share, there's no way that you're paying up for quality at 35 times earnings and you have some kind of a margin of safety if something goes wrong. A margin of safety is always important because once you pay those high multiples, you're pretty much betting on the best case scenario. If the best case scenario doesn't happen, and the company doesn't grow as much as you're expecting, then you have massive downside on the multiple. But if you wait for a lower multiple, like what I value them in my videos, then you at least have some kind of a margin of safety in case something goes wrong, which is why I always value those stocks on the worst case scenario and not on the best case scenario. But the reason why people don't wait and they tell me in the comments is the stock will never get to 87. Netflix will never get to 87. Microsoft will never get to 420. But for me personally, I don't really care if they get there or not. I don't care about missing out on those stocks. I don't approach those stocks with the mindset of FOMOing into them. Every time I FOMO into a stock, I lose money. I don't know about you guys, but it's the same thing with me. Anytime I fall in love with a stock and I'm like, I like the company, but it's overvalued, but I'm just going to pay up for quality because it's a quality company, I lose money. every single time pretty much. And this is something that Warren Buffett said. Warren Buffett said the stock market is a no called strike game. You don't have to swing at everything. You can wait for your right pitch. So for me personally, I don't care if MasterCard doesn't get to my fair value and MasterCard goes up and it keeps on going up and it's just traded at a crazy multiple at 50 times earnings. I'm not going to learn the wrong lesson and pay up for another stock like CRM and have 5 years of 0% returns. It's important not to learn the wrong lessons. So for me, if a stock doesn't get to my fair value, if I don't believe there's enough margin of safety and I missed out on it, I'm perfectly fine. I could just wait for another one. I don't need to FOMO. There's always going to be another MasterCard, another Rocket Lab, another Palantir. There's thousands of stocks in the market. So why do we need to pay up for quality if, let's say, we have an alternative of Meta trading at 20 times earnings, or something like Amazon, which was trading at 15 times operating cash flow? Why do I need to pay up for MasterCard when it was trading at 30 times earnings? Just because it's a quality company? But I have no margin of safety on the multiple. So this is how I think about them. I don't pay up for quality. To me, it's all about quality versus the price. And I approach it from a value investor mindset. That a margin of safety is important, especially on the multiple. Because if something goes wrong, if the growth slows down, if something happens, and you're paying a high multiple relative to the growth, you don't have any margin of safety. And you have room for a massive multiple contraction. And a lot of those stocks don't recover from this multiple contraction. The second one is GAAP versus non-GAAP earnings per share. So this is a big one with a stock called Now, ServiceNow, big stock amongst retail investors. A lot of people in my group have been asking me about it, and I've been telling people it's a trap. And I told them my fair value is $130 for the last pretty much 10 months. To me, it was obvious. Why? Because when I looked at ServiceNow PE ratio, the stock was trading at like 50 times forward earnings, okay? But 50 times forward non-GAAP earnings, which is $4, okay? Now, if you look at GAAP earnings, which is a difference of stock-based compensation, it's almost 50%, it's almost half the non-GAAP PE ratio. So right now, for example, ServiceNow is trading at 38 times non-GAAP earnings of $4. If you use GAAP earnings, it's trading at 70 or 70 times forward GAAP earnings. It's always important to look at the difference between GAAP and non-GAAP. And if you paid up for ServiceNow at $100 or $200, you are paying more than 100 times GAAP earnings because you did not factor in stock-based compensation. The company has massive stock-based compensation. Their stock-based compensation is $1.7 billion. Their net income is $1.4 billion, and they added back, and then their non-GAAP EPS looks amazing. And that's a common one amongst a lot of the software as a service stocks. CRM is kind of the same way. Adobe has a little bit, not as much as ServiceNow. Snowflake is a big one. Zscaler, a lot of the cybersecurity stocks. Rubrik is a big one. It will never be GAAP profitable pretty much. So it's always important to look at GAAP versus non-GAAP and try to value those stocks while factoring in stock-based compensation for you to get the actual valuation of the stock without paying up for the company. The last one, which I believe is an important one, and this is a common one, especially for newer market participants and newer investors in general, is investing in the present. So most of the newer investors, they see what's popular. Let's say the drone stocks right now. So they want to invest in a drone company. Why? Because everyone's talking about them and the government signed a contract with some company and they made it a priority. Well, if everyone is talking about it and those stocks are up hundreds of percent, maybe you're a little bit late to the party. Maybe a lot of those expectations got factored in the price. And a lot of those drone stocks are trading at 50 and 70 and 90 times sales. I've looked at them. One of them is at 90 times forward sales. So maybe a lot of it is factored in the present. If you're investing in semiconductors right now, I think there's a lot of optimism around semiconductors. A lot of it are priced in. This is something that Stanley Druckenmiller said. He said, never invest in the present. Always look at how the world could look like in the next year or 2 years and try to invest based on that. And if you're excited about what is popular right now, then you are most likely paying up for what's already factored in the price. And that's a really big one. For me, I like to invest in what is something that people are not excited about. For example, last year the oil stocks were hated. I did a video that says this investment will make millionaires in 2026. And I talked about the investment opportunity in oil and how oil was just hated and people were hating on it. Well, this year is a big year for oil. ExxonMobil is up 10% year to date. My oil stock is up 20% year to date. We just started. And it was really, really hated. Same thing with the gold miners for many, many years. Same thing with the defense stocks. Not right now, but before. Now they're a little bit popular. Maybe right now healthcare is still hated, software as a service is still hated, and this is all a rotation. The market always favors something and it dislikes something else, and the sectors that it dislikes normally sells off more than it should. And you can find a lot of bargains, a lot of opportunity, and eventually something happens when the market realizes that this sector is oversold or some kind of a catalyst happen, and then this boring sector becomes favored again, and the semiconductors or whatever is popular right now will go out of favor for some reason because of the AI bubble or oversupply. And this is a time to buy semiconductors. It's not the time to be FOMOing into semis right now, in my opinion, whenever they're just making new highs and everyone is going all in and there's a lot of optimism. So that's a very important one, is to not get excited about what's popular and to never invest in the present, gap versus non-gap, and paying up for quality. If you're interested in learning a little bit more about what I do and how to value stocks, and I have many educational content videos, and I share all my stocks and everything I do in my group. This is the link if you're interested. But thank you very much for watching. Hope you enjoyed it. It was a financial advice. If you want more of such content, let me know in the comments. So thank you for watching again, and I'll talk to you in another video.